Yep.
So for a number of years now, especially since COVID, people ask themselves, where should I invest my money? We want to be independent. We want to tell the client whether or not it's a good idea to do the deal.
Yep.
And so when I started with Rödl Partner, I was at a seminar and I had like 20 seconds to introduce myself. And I said, my name is Rödl Breitenfeldt and call me before you sign an LOI.
Welcome to the Westbound Podcast. My name is Matthias Oertzen, founder and managing director of the Oertzen Group. Each month we bring you international business leaders to share their personal and professional journey in North America. Thank you for spending time with us. And now let's get to it.
Welcome to the Westbound Podcast, where we serve the European business community. I'm really excited today to speak with Frank Breitenfeldt from Rödl Partner. He's responsible for mergers and acquisitions within Rödl Partner, and I'm really excited to learn a little bit more about that today personally, but also for audience, obviously. So welcome, Frank.
Thanks for having me.
Yeah, it's really good that you're here. We just had a good meal together and learned a little bit more about you. I think we kind of knew of each other through our common circles that we're in this business. Tell us a little bit about yourself, like where you're from in Germany, how you made it to the US, before we dive into M&A.
Sure. I just had my 20th anniversary coming to the US on January 12th.
January 12th? Okay, for me it's March 15th, so okay.
Yeah, so no, I came over with Big Four. So I worked in total for 15 years with Big Four. And with them, I went to America because keep in mind, Transaction Services, everything is in English, even in Germany. So of the 500 reports that I probably have written in my life, 497 were in English and 3 were in German. And the first 100 came back in red.
Okay.
So after the Steuerberater and Wirtschaftsprüfer exam, I decided that I should go abroad for 2 years. So I was just as an expat, then I came over. It was already in Atlanta. And then I stayed with them until 2012. And then in 2012, I switched over to Rödl Partner, pretty much across the street, when I recognized that the German background is an asset and not a liability.
Not a liability, okay. Yeah. So all of a sudden, the German was wanted and not a funny accent in every transaction.
Exactly,
yeah.
Exactly. And so I was born in Bremen, grew up in Delmenhorst. And then I studied in Essen and in Berlin.
In Essen and Berlin, okay. Excellent, very good. So, and then it's been, you said 20 years in the US now, right?
Correct.
Yeah, very good. And then, so were you already in transaction services with KPMG as well?
Yes. So I started in 97 in audit, and then after 4 years, I switched over, which was pretty much the time when the term transaction services was established in the market for the financial and tax due diligence.
Okay.
So they had like a handbook for all the employees in the late 90s. And at that time, the term transaction services was still not there. So they called it special engagements. It sounded a bit like CIA, secrets. So I said, great.
Yeah.
So, but when I switched in 2001, then it was already transaction services as the term.
Okay, gotcha. So that's going to be really interesting when we get more into the weeds. I'd like to know how that was actually done before. I'm sure there was a lot of lack in due diligence before how those transactions were made. But so you was Rödl Partner now. I think many of our listeners already are familiar with Rödl Partner. But maybe you can give us just a quick synopsis of what the firm does, and then we'll get into what you do about the firm. Yeah.
Rödl Partners is a CPA firm, and our unique selling point is that we are specialized in the German and German-speaking inbound business. So Rödl Partners is now in 50 countries with 5,800 employees. In the US, we're now in 10 different offices with 400 employees. And I would say 98% of all of our clients right now are still the European inbound business. So there are some German ties, except for some special, let's say, departments that we have, and transaction services is one of them. Yeah. So still, the vast majority of my deals are where the German or German-speaking client comes from Europe and wants to buy a company in the US. So we would work on 80 to 90% of our deals are where we work on the buyer side. But then the 10 to 20% are sell-side engagements, and they may or may not have any kind of German ties. Yeah, so it's a bit of a standard that if you want to sell your business, that you prepare a quality of earnings report, and the investment bankers bring us in. Yeah, so the investment bankers organize the whole sell side process, and if you exceed a certain size, it makes absolute sense for you to look at your own figures prior to go to the market, so that you have a good basis also for your own valuation, and you can streamline the process so that the buyers, you have 10 different buyers, they all ask the questions, so you rather want to streamline that by giving them already a good document that tells most of the story. And that's what we do, and that's the reason why. So when you ask me where I want to see ourselves in 5 years from now, I would say that's the biggest development, that we work more in the domestic market, where there's not necessarily any kind of European ties.
Okay, very interesting, very interesting. But for now, it is really a German company, decides for some reason. What would be some of the reasons that some of your clients approach you for? Like, why are they purchasing within the US? I'm sure there's different reasons.
Yeah, I mean, typically it's because the US market is just too big for you to neglect that. Rödl Partner also grew a lot because the automotive business went to the South. They were pretty much, the OEMs went to the US, and then they said to their tier 1 suppliers, you have to produce locally. So then they went. There was a point in time that 30% of our clients were automotive related. It's now much less, but that was also part of the growth and part of the reason why we specialize on this type of German inbound business, because there was such a pressure coming to the US. That pressure, I think, is not gone. I think it's quite honestly, it's even more than ever. So when you think about why people want to come to the US, or why people want to invest their money, if you, right now you have a war in Europe, you have problems in the Far East. So for a number of years now, especially since COVID, people ask themselves, where should I invest my money? I could invest my money locally in Germany, but then when you look at the GDP rates, it's not exactly the most booming market. And that's the reason why the US, for a number of years, seems to be a safe harbor for your investment. And therefore, it's a bit of a market pressure. But that's typically what we see as reasons for people to come to the US. And then they have two different reasons, or two different options. The one is the greenfield project, where they want to build their own production and then develop their own business, or they buy something. And most clients, they want to buy unless they don't find anybody, and then they do it themselves. But doing it yourselves takes 5 to 7 years to really be established in the market. Whereas M&A could be the jumpstart, even if the production is not perfect for your own purposes. But it's just faster.
Well, you've got profit right away, right? Ideally, this is a profitable company that you're purchasing. All the capital equipment is there. The employees are there. All the permitting has been done for wastewater, whatever the plant it is you're buying, right? So you skip all those steps, and it's almost like a Monopoly game where you skip a couple of fields and start further ahead. Interesting, yeah. I had one client actually. They were out in California, and it was quite interesting. They ended up acquiring, or were in the process of going through the due diligence to acquire, I don't think it was your deal, but they were going through the process of due diligence to acquire a trash hauler, because it was impossible in LA County to get into those contracts unless you would acquire someone who already had a contract. So there's a very unique reason why they wanted to go through acquisition rather than trying to start some of this stuff they want. That deal actually fell apart, if I remember correctly, because the seller was unable to really produce all the documentation that was needed by the auditing team to let this transaction go through. Do you see that a lot? Do you see a lot of deals fall apart because of the seller maybe not being as prepared as they should be to go to market?
Yeah, sure. I mean, keep in mind, the typical deal that we do is a one-on-one deal, meaning that the buyer and the seller talk to each other, they agree to a letter of intent, and then our due diligence will start. So it's rarely that they have an auction process. It's more the exception of the rule. In my old days, it was more the rule than the exception. It depends on the size of the business. It depends on how sexy the business is, whether you as the seller decide that you want to have a sell-side process and test the market by sending teasers to a lot of different firms and figure out whether they want to buy you. So our deal, I would say 80 to 90% of our deals are one-on-one deals with exclusivity, and then they look into the business. What it means is that if they also don't have a sell-side advisor, and the quality of sell-side advisors is very volatile, so it could be one-man shows that have done maybe a deal already a year, and they only have to do one deal a year to be rich. So that's the reason why sometimes, even with an advisor, the sell side is not well prepared.
Interesting.
There's a chance.
Yeah.
You know? And then if you don't have a sell side advisor, which happens a lot for us, then it really depends how good they are. Typically, when we send our RFI list, our request for information list, it takes them a week to 3 weeks to prepare that. But sometimes it takes forever.
Yeah. I can imagine.
And then the deal breakers could be everywhere. It could be in the financial due diligence when you see the figures, the reported figures, but then you look at non-recurring extraordinary items. So there could be reasons why the reported figures are not what you really use as a basis for your valuation. And you figure that if you figure that out after you agree to a purchase price and you want to renegotiate because you're saying, well, what I told you was based on reported figures and you didn't tell me that a big chunk of your profits will not be recurring. I have to adjust. And that's the reason why deals could fall apart. But it could also be legal reasons, what you mentioned earlier. If they cannot produce certain permits or any kind of contracts that you think about, there could be various reasons why a deal falls apart.
Interesting, yeah. So that's really, if we were to go with a real estate analogy, it is really an off-market deal. So this hasn't been advertised to anybody else. It's a buyer and a seller found each other, and it's a one-on-one deal. That's what I think you just called it.
I think a lot of times also we see that our client negotiated with the seller
already,
not to buy the company, but to just work together. They wanted to work together because they're in the same business. They know each other. And then they figure out, oh, by the way, I'm 68 years old and I don't have anybody who wants to take over. So sometimes it evolves.
And then so let me ask you this too, on the letter of intent. Is it in the letter of intent, is this a letter to engage in negotiations, or does this usually already state a potential purchase price? Is this an offer?
Yes. So typically, when let's assume you really have this one-on-one situation and not an auction. Yes, they talk, and then at some point in time they figure out maybe we should buy you. And then we would expect that the seller provides maybe 3 or 4 documents, not much. So financial statements of the last 3 years, maybe a legal org chart so they understand the situation, how many legal entities you have, and so on. Maybe some tax returns so that you understand whether he is open for a share deal or an asset deal and what the tax consequences are for the seller. Because you, as the buyer, typically rather prefer an asset deal for tax reasons. So once you figure that out, and you have asked certain questions about the financial statements, do a light version of this quality of earnings analysis that I mentioned earlier, that you understand whether what you see is what you get, or whether there are any reasons why this should be different. Sometimes, for example, if the sole owner, he could make $50,000 a year, or he could make $5 million a year. We have seen both in the past, but you want to normalize those expenses so that you have like an adjusted figure that really is the go-forward figure. And once you figure that out, and of course you talk about a lot of other things, such as how many years do you still want to stay with us, whether the seller goes out on day one, because typically he runs the business, or whether he wants to stay for 2 or 3 years. Those are all the negotiations that you have already prior to preparing a letter of intent.
Interesting,
And then the letter of intent is the big major step. It's non-binding in nature. It's like 5 or 6 pages long. But quite honestly, it's such a big cornerstone of the whole negotiation. You better want to make sure that you have a lot of things already agreed, even if it's non-binding in nature. You should talk about the purchase price. I have seen LOIs where they don't have a purchase price mentioned. It's not a good idea, because then it's not a good idea for the seller anyway. The seller should always insist on a letter of intent, because that's the last time he has a lot of negotiation power.
Sure. Because once that number is out, that's it, right? You're not going up from there.
Yeah, I mean, you could go. Going up is
it's
tough,
difficult.
But sometimes it happens. If your year-to-date results and the project could last for 3 or 4 months, we have seen renegotiations because they exceeded their own budget, and they said, "Look, my business is so good." So that happens. But what I want to say is that the letter of intent is very important. So when I started with Rödl Partner, I was at a seminar and I had like 20 seconds to introduce myself. And I said, my name is Rödl Partner and call me before you sign an LOI. and it's now a running gag within the firm. Every employee of Rödl Partner in the US knows that term. And that's the reason why they always insist and make sure that the client understands that even if it's non-binding in nature, you better talk to us already, because we have seen so many mistakes in that letter of intent. For example, the purchase price is $5 million. Oh, the purchase price. So what is the definition of the purchase price? Is it an enterprise value? Is it an entity value? Is it cash and debt free? So you need to define certain things, and you cannot just call it purchase price.
Right. Yeah.
Yeah. And that's the reason that's one point. My checklist is like 15 items long that I look at, and it doesn't cost a lot of money. It cost me maybe an hour in total to look at a draft LOI, but you better want to have somebody look over it before you agree to it, because in a lot of cases the lawyers are still also not involved. Okay. So our clients, they call us and they draft something by themselves, especially if they think they have done 5 deals already in the past. Sure. But then they may not have done a US deal. Yeah. So for example, the Germans like lockbox deals. Yeah, lockbox means that you agree to a purchase price based on a historical figure. Okay. So let's assume you have an audit report at the end of last year. You use those figures to determine the purchase price, and then you say, effective that date, that lockbox date, it's my company, and you achieve that by not having any kind of distributions after that date. Okay. So that you have like they call it leakage. Yeah. So if the owner still grabs into his own pocket because he didn't know on January 1st that he will do a deal. Sure. Yeah. So in March he agreed to a lockbox deal as of January 1st, and he didn't know in those 3 months that he sold his company already. There goes $500,000. Yeah. Okay. Yeah. So that's the reason why you have to readjust the figures, because you use that December figures as a determination of the purchase price. Interesting. Yeah. The Europeans love this. And the Americans don't know about it. So if you agree to a lockbox deal in the LOI, and I haven't seen a client in America who said that was a good idea. So we have done lockbox deals in the past in the US, maybe 10 in total, but everything was complicated. So you have to convince the seller that he understands the concept, and you pretty much have to convince the seller's advisors, the legal advisors who have never heard of it. Right. But you even have to teach sometimes your own legal advisor, because they also have never heard of it. Okay, and what would be the alternative? What are the Americans used to? Americans do closing accounts. Okay. So what it means is that you agree to a purchase price, and then you have an adjustment mechanism for the working capital and for the net debt. Okay. And you look at the closing balance sheet. So if you buy the company as of the end of March, for example, which is a future date. Right. So you sign the contract. Typically, you have signing and closing at the same time. Okay. And then the buyer has like 90 days to finalize the closing balance sheet. We typically come in and audit the work so that we make sure that these figures are accurate. And then you send it to the seller and you say, oh, by the way, the final purchase price is $200,000 less or more, depending on the figures that I finalized, and you have now 2 weeks or 30 days to review my work, and then they ultimately agree to it. Interesting. Which means that the company is owned by the seller until that closing date, and there's no retroactive. Nothing. Okay. Yeah. Interesting. Okay. Yeah. That's also how real estate works in the U.S. Yes. It's probably very similar to that, like looking at taxes and arrears and other things. Okay. Interesting. Yeah. So you get involved ideally much earlier than the actual LOI. So call me before you sign the LOI. Yeah, we'll brand mark that statement or copyright it. That's what I meant. What's very interesting to me as well is you called it FBI, CIA earlier on, but like special operations, I think that's what it was called. The special engagements, yeah. So it is literally that, and you present mostly the buy side, not the sales side. That's correct. Well, right? As I said, the future is probably more on the sales side. Yeah. Right now, I would say it's 80-20. 80-20, gotcha. But keep in mind, the 20%, if you do a sales side engagement, it could also be very complicated. So we had one project which lasts for 2 years because the client wanted to sell a business unit that he has never reported on. Okay. So he didn't know anything about his own figures. Wow. And therefore he had to engage somebody, and that was us, to prepare his own financials in order for him to be ready, to be market ready, so that a potential buyer can see how the profitability is. And it was an eye-opening project for themselves, because they didn't know their own margins. They never did this kind of business unit reporting in order to figure out what is our true profitability. And as a consequence, they renegotiated their prices with the customers because they recognize they don't make money. So and then of course you go to the market, and it took a longer time, but it was an incredibly complex project if you can think about it, it's like a chainsaw massacre that
can
you
imagine.
go through the production and you say, this product line, yes, and this, no. And then you try to pretty much carve out those revenues and expenses and allocate them appropriately and put it on a standalone basis.
Right.
So, and that was incredibly complex, but also incredibly helpful for the whole sales process. If you don't have that, you cannot sell the business.
Yeah. Imagine. I can only imagine. How large is your team? I know that
We're close to 10 people now.
10 people, okay.
When I started in 2012, I was by myself.
Yeah.
And then I had a second person that I landed from the audit department. She has helped me for a year, and then she forgot to tell the other folks that she has now 2 jobs. And she loved her own clients, of course.
Yeah.
And then ultimately, it was a lot of work for her. And I said, well, you have to reallocate. But she never joined my team officially. That was probably not a good idea from our side. And then a German came in for 2 years as an expat. And then we grew and grew. And then in COVID times, we had a bit of a stop. So we didn't hire. Actually, we hired somebody who just joined then in March. And I think he made it for 1 week into the office. And then
COVID broke out.
And then he had to stay in his bedroom for the rest of the time.
Yeah, I can imagine.
He said after 9 months, he said it's not a good idea. I think I should go home.
Did everything come to a screeching halt during that time, or were you able to carry on quite?
Good point. Typically, so the financial crisis felt like a crisis in 2008.
I can imagine.
But COVID didn't. And the reason for that was our corporate clients all stopped. Yeah, so we had one deal that was canceled. No deal was canceled because of COVID, but no new deal after March 2020 pretty much started for any kind of corporate clients. The private equity guys were more active than ever because they bought all the COVID winners. Yeah, so they have like an investment pressure because they have a fund that they have to invest.
They have cash and it needs to be deployed, right?
Yes, and so they were very active, and that's the reason why it never felt like a crisis for us. When you look at the statistics, the fourth quarter of 2020 was already very picking up a lot in the domestic market, and we didn't feel that. Yeah, and the reason for that is because the Germans still couldn't travel, and that's the reason why we pretty much woke up from COVID in March 21, and then it was like a wave, and 21 was the strongest M&A year on a worldwide basis ever, and then.
So what's that like? Low interest environment, right? Pinned up demand from COVID, right? So it all comes to everybody gets to be out again and fly around. I know it's not actually a reason, but I guess all of those things together made it the strongest year ever.
Yeah, quite honestly, I mean, we saw a lot of sellers who said, "I survived COVID.
Yeah, now I'm selling.
I'm good.
Yeah.
I'm good.
Yeah,
a lot of our deals are generational deals.
Yep.
But yeah, they survived COVID. And by the way, because of all the COVID support, the financial support, there was nobody who had to sell. Yeah, so we expected a wave coming in because of all the bankruptcies, and the bankruptcies didn't happen.
Never happened, yeah.
Yeah, so
PP, he said PP
yeah,
loan.
PPP loan.
Yeah.
I mean, it's both in Germany or in Europe as well as in the US, the support was very strong. And by the way, and if you didn't need that support, you had a lot of cash.
Yeah.
So there was also partly cash induced that people said, well, I have too much money, I have to reinvest.
Yep.
Yeah. So yeah, 21 was the strongest year ever. 22 was lower than 21. 23 was significantly, I think 30% lower than 22 from an M&A activity perspective in the domestic market. Yeah, you don't have much data of how much European inbound business comes to America. That's tough because it's a lot of private deals that are not published.
Yep.
So getting data is very tough for that. But what I try to say is that in 23, for example, all Big Four companies fired people between 5 and 8% because they just recognized they overhired in those very
boom
nice years, boom years, and we never recognized it. Yeah, so I wouldn't call it a wave. I would call it a midterm effect that started in 21 is this on the same level in 23 and in 24, i.e. that we still see that the European inbound business into America has unchanged.
Yeah, now probably for different reasons, right, that you mentioned earlier. I mean, the geopolitical environment, also maybe deploying money now in North America instead of, in Asia somewhere. That's a lot what we see. I mean, there's a lot of and I know you cover that at Rödl Partner as well, the whole site selection process and finding a facility for a greenfield or finding the area and the community to do it. And so we'll see a lot of that coming inbound, and then some of those turn into more of M&A deals kind of thing, so it's quite interesting how that's carried on. I was going to go back to what you mentioned earlier. So you come in early before the LOI is signed, everyone, and you're on the buy side. So you have a team of 10 people. Can we literally envision people jumping on a plane, going to the acquired target and starting looking through folders and looking at the invoicing department, looking if machines are really in place that were on the balance sheet, are you actually doing like physical audits, doing an inventory? Like how does that work?
Yeah. So prior to COVID, we traveled for every project, even the smallest project. Keep in mind, we had these one-on-one situations, and we had a seller who sells his baby, so meaning he does that once in his life, and we were more on the driver's seat to tell them what we need to do. And that's the reason why I always said, regardless of how small or how big the deal is, we will be in the field for 2 days and interview you. And it was a lot of fun, it was good, but it was also a lot of pressure. Pressure on both sides, so part of the reason is you show up at after lunch, you ask questions, and then you ultimately also probably go to dinner, and then you get all the data that you have requested, and you want to process that before the next morning. So it was we always work 24/7 in those 2 days, and then the second day you try to address almost every question that you have in those 2 days, and that was tough. The advantage was to see the guys and look them into the face when you ask a question. And we can also see the dust on the inventory. We could see the fixed assets. I mean, we don't perform a technical due diligence. So I'm not trying to understand how old and how great the machine is. Of course, it helps to see this a little bit in action and have an opinion about it. And inventory is always helpful. Yeah? I mean, I once looked at a distribution business, and then, it was probably like 3 soccer fields big, the whole warehouse. Yeah,
it's tough to tackle in 2 days. Yeah.
And then they so we said, okay, can we do a walkthrough? Want to see the stuff? The client said, I have seen enough warehouses in my life. Yeah. So he was, just by chance, the client was around. Yeah. And then we walked into the warehouse, and they didn't turn on the lights for part of the whole warehouse. And I said, what is there? You don't want to know.
No way.
Yeah, because it was so dusty.
Yeah.
It was not moved for 3 years.
Yeah.
And I said, well, turn on the lights.
Turn on the lights. Let's take a look at it.
And it was, of course, very helpful to see all of this.
Yeah.
So that was pre-COVID. Since COVID, I probably traveled.
Did that deal happen? The warehouse deal?
Yeah.
Okay. Okay. It went through.
Well,
okay.
After the inventory was devalued, yes. Yeah.
Good. Yeah.
But since COVID, I traveled probably 5 times domestically. I mean, I traveled to Germany 4 times a year or 5 times a year to meet clients and potential clients. But for a deal in America to travel, I did it 5 times, mostly for management presentations in hotels somewhere, and still not for these local interviews.
Okay.
Having said that, whenever we do it, we see the advantage. But our budget so when the client calls and says, I want to do a due diligence, we assume we don't travel.
Okay.
We tell the client, if you want us to travel...
There's an expense retainer, for example, or something.
Yeah, it costs you a day extra.
Sure.
Because we stay at the airport pretty much for a day in total. Yeah. So we tell them, and so far the clients don't say, please do so.
Interesting, yeah.
Yeah, and that's the reason why we don't travel anymore. We have now 2 to 5 conference calls times 2 hours for the financial side, plus 1 call for the tech side. And then we ask those questions, and the big advantage is you're prepared. Yeah, you only have to. It's not exhausting for the seller. It's only 2 hours. But then you ask all the questions, and you get a follow-up email with all of the follow-up items. And then once they are processed, we have the next call. So it's like a 2-week, maybe sometimes 3 weeks of a process where we ask our questions, and then plus the processing in the beginning of the data raw material and writing the report. So a typical project is 4 to 6 weeks.
4 to 6 weeks, okay.
If everybody is focused, yes.
From literally, and this is from pre-LOI to closing date?
No. So 4 to 6 weeks is the actual due diligence.
Due diligence, okay.
I would say 3 months is a good from start to finish. I would say 3 months once you sign the LOI. Because the LOI, it's as long, even if it's only a 5-page and you know what you want to say, it's still a negotiation thing. It goes back and forth. It's not on the highest priority, so it always takes a week or two for the other person to answer and to send back a markup. So I count from the signing of the LOI until the signing and closing of the deal. That is typically a 3-month process, but it could be much longer.
Interesting.
But 3 months is if you're focused. And then we sometimes have clients who say, "Oh, I'm going to do it in 6 weeks."
Yeah.
And I say, "Well, you don't." And I can tell you why you don't.
Yeah.
Because just the SPA, the the sale and purchase agreement, takes you a couple of weeks because you play ping pong.
Yeah.
You write a first draft and then you get the markup back. The markup should be relatively complete, so they will take a while. They don't send you back a version, "Oh, this is my first set of markups." And they do it within 48 hours. No, they take it a week or two to write back or longer. And then you come back and then you do this ping pong.
Yeah.
And if you only do 3 times ping pong, it's good. It could be typically more. And then sometimes, which I don't see since COVID that much anymore, that people still travel and have one final meeting where they pretty much lock up the room and say, "You only come out when you're done."
When you're done, yeah.
So that the lawyers have to be in one room and agree to a deal.
Okay, yeah, interesting.
Yeah, you don't have that much anymore. And that's the reason why it's just not possible. And what you also don't want to do necessarily is that you start with the SPA, with the purchase contract, prior to doing the due diligence. So we typically are in the forefront. So the financial due diligence is done first, sometimes concurrently or oftentimes concurrently with the tax due diligence. But then the legal side, if they also ask all of their questions at the same time, then the seller is typically overwhelmed. So they sometimes do it concurrently, but often they do it after that. But in order to be on this super tight timeline, they need to draft the purchase agreement already at that time, and that's typically not a good idea.
Yeah, this is incredible. I mean, thinking of if I imagine, I mean, we are in this day to day, being from Germany, having lived here for 20 years. We know the culture there, we know the culture here. I don't know how someone would do, unless they're like the very big boys, right? Right? How would you do a transition if you're from the Mittelstand and you don't have someone like you, actually as a facilitator in those kind of deals? Talk a little bit about that, the cultural differences of the American seller who is, is probably family owned, right? And you were saying it's their baby, and now they're, I don't know, coming up with the age 67, and all they want to do now is be on the beach in Destin, right? And here comes this German company, probably also family owned, right? Or started by a family and now a CEO running it. What are some of the things you're seeing? What are some of the cultural misunderstandings, differences in those deals?
First of all, even the 67-year-old seller who sells his business for the first time in his life, he is still much better at negotiating. So Americans are very good in negotiating in general. Yeah. So meaning that they have a price in mind. They can also do this give and take. Yeah. So coming up with with something which may be out of the ordinary, then to put it back. But then you already have a bargain because you said, well, I gave up that point,
right,
even if you didn't want to, even if you didn't care about that point.
Okay, so all these different aspects and then moving chips back and forth to come up with a better overall deal. Okay.
I think this negotiating, I rarely see that Germans try to renegotiate the purchase price, but if they do, they start oftentimes, not always, but oftentimes they start with where they want to get out. Yeah. So let's assume 10 million was the LOI purchase price, and then they say it shouldn't be 10, it should be 8. Yeah. An American would start with 7 to land at 8.
Yeah.
Germans start at 8.
Yeah, it's true.
And then they are surprised why they land at 9.5.
Yeah, exactly. Everything's too expensive in the US.
Not only that, but also because because
it's not in our nature. I don't think it's in the nature, in the German nature, to be negotiating, that's also when maybe I'm shooting myself in my own foot, but like when we work with our clients, there's not too much negotiating going on. It's hey, this is what we charge, and yep, I think that seems fair, and we shake hands and we start on finding the next president, for example, right? Well, watch now, next week everybody wants a discount, but it's. Do you think that's correct? I mean, a little bit, right?
I don't know.
Yeah.
I mean, the story of Rödl Partner. So Rödl Partner came to the US in 2001, and then we worked together with so Rödl Partner and the company Langford de Kock went together to do joint business. So Langford de Kock was already specialized in this German inbound business at the time in the 90s, and my understanding is that they were in the same building as the GACC, the German American Chamber of Commerce. And I don't know whether it's true, but I want to believe that story, that they worked for American clients and for German clients. And then the American clients at the end of the project said, can we do it cheaper? And the Germans said, thank you.
Yep.
And
totally
that's the reason why ultimately they said, maybe it's a good idea to work more with the European inbound business.
With the European inbound business. Okay, interesting. Yeah. How large are the deal sizes? Like if you were to put kind of a estimation on it?
So when I started as a one-man show, of course, the deals were rather somewhere between 2 million and 20 million in revenue. Yeah, so not purchase price, but just the target revenue that we looked at. I don't think there's a limit downwards. So you should always do a due diligence, even if the company makes less than 2 million in revenue. And now, because we have the bandwidth, we still work on the smaller deals. And when I say small, I mean something between 5 and 50 million is for us the sweet spot where we say this is the majority of the work. Partly also because the Germans don't try to do the big bite.
Right.
So they don't try to grow by 30% by buying a company in the US.
Yep.
That's also, I guess that's also the reason why, on average, they are successful in their deals. So when you look at these polls later on, when they ask companies 5 years after they have done a transaction, whether it was a success, 2/3. I mean, it's a longer time ago that I saw this, but 2/3 of the answers were that was not a good idea. It was not a success. Yeah?
Okay.
And partly it's because they
And
put
this is across all equity, or this was just for the German population?
No,
Yeah.
across all.
Okay,
when you just
all
talk
deals.
in
Okay,
general
yep.
about M&A,
Yep,
this
yep.
has nothing to do with German US.
Yep.
You see that 2/3 of the people would say it was not a success, and the reason for that is mostly because they put too much expectation into it. Meaning they want to have a lot of synergies, they want to boost their own business, they want to cut the expenses in half, and then all of a sudden, and the purchase price was based on those assumptions. And that's the reason why they buy very, very expensively. And then ultimately, they recognize it was too expensive, or it never materialized. And then they have the problem to explain, this was the business plan that was the basis for our transaction and for our decision to buy it. And then the actuals look much worse. Yeah. And I would expect that our clients say the opposite, that 2/3 at least was a success, and partly because they don't try to revolutionize. They are more or less the white knight in most cases, because they buy a business and they don't want to dramatically change it.
Right.
Yeah. So they look at a successful business and it can stay successful, plus let's say the good impact of selling your own products more in America, whatever you try to achieve with the transaction. But that's the reason why I would expect that our clients are very happy, just because they don't try to make the biggest acquisition in the world all at once, and then the integration fails.
Yeah. I see this a lot we do executive recruiting and professional recruitment, right? So often we come in to these failed post-mergers. I'm working on one right now, really, where acquisition, they never had a real cultural integration. Actually, I can think of two right off the bat. Fairly large companies, both. You can just see that the company has not become one. I mean, the European entity and the US entity, they're not working hand in hand, still culturally very much operating in their own way, still a lot of misunderstanding. In one case, actually, the company was financially gutted by the European entity, and now they've got a new CEO. There's a lot of reinvestment that needs to take place, so it's quite interesting for us to see how those things go. And then I mentioned the other one that actually didn't work out, and that there's a whole host of stories with that one as well. There's other ones that didn't work out as far as M&A.
But yeah, you asked for the average size. So I would say that's still our sweet spot.
Yeah.
But now we do also the very big deals. Yeah? So enterprise value could exceed $1 billion. We have seen several projects with more than $1 billion in purchase price. My current record is still $5 billion. It could have been 9, but then somebody else offered more. So our client came in at a very late stage, and within 12 days they made a final offer.
Wow. Okay.
And was very, very last minute. I suspect our client never had a chance. I don't know, but yeah, ultimately it was a U.S. buyer. But
So this one that was shopped on the sales side, right? Like this was
that was an auction.
Yeah.
And what was unique in that project was that they never granted exclusivity at any point in time. So typically, when you have an auction, where you have an investment banker who prepares a sell side process, he sends a teaser to several hundred potential buyers. Then you send an expression of interest, and you say, well, I could think of X. And you already give a range of a purchase price, just based on a couple of pages that you have received.
Interesting. Okay.
And then they say, so congratulations, you are in the next phase. So that's what I would call phase 2.
Okay. And can be more than one go into the next phase?
Yeah.
Okay.
10.
Okay, 10.
So
okay.
you better have 5 to 10 bidders
Okay.
in that phase. I mean, sometimes it's only 3. It depends on how sexy your business is.
Sure.
It depends on how sellable it is. It also depends on if it's too small, then the big companies are not interested. It also depends on whether you have a succession plan. When you are dependent that the management stays and the management is the seller, that could also be a reason to not engage as a potential buyer. So it depends. But I mean, I don't see it. Of course, the investment bankers never tell you how many other bidders are in the game.
Yeah, of course
but,
not. Yeah.
But I would expect somewhere between 3 and 10 is a good number.
Okay.
And then you have your confirmatory due diligence. That's where you also look into the quality of earnings reports that I mentioned earlier that are prepared by the sell side advisors.
Let me interrupt you real quick. So on this, when that happens, it goes to auction. That's what you called it, and you see what they're shopping it for, the pricing, and then later you come in and do your audit. How often is that way too far marked up, or way off base, or is this? Is there too much? Or is this usually a pretty realistic ask that comes through?
Well, you received figures.
Yeah.
So meaning you have a basis.
Right.
You received the financial statements of the last 3 years, hopefully, and then also a business plan. The business plan may be overly aggressive, and you take it at face value in the first phase because you don't know anything else.
Sure.
Unless you do. Unless you're very much into the market and you know already that this business plan is not realistic, then you may use different figures. But you do have figures. And you have in a lot of cases, they do either a DCF model, a discounted cash flow model, especially when you have a business plan, or you do, which is the more pragmatic way, a multiple-based valuation, where you just use 1 year or maybe an average of a couple of years of an EBITDA figure, and then you multiply that with the industry multiple that you are willing to pay. Yeah. So those assumptions, they cannot be wrong. Yeah. What could be wrong is that the basis, meaning the EBITDA figures that I mentioned earlier, that after our due diligence, we see they are not sustainable.
There's holes in it. Yeah.
Yeah, there are holes.
Yeah.
There are certain one-off effects included. You cannot imagine what people included in those figures.
Tell us some.
For example, the PPP loan.
Yeah.
Yeah. So you got a loan. The loan was forgiven, and then you have a huge a positive effect by forgiving this loan.
Sure.
Yeah, which is the biggest one-off effect that you can imagine.
Yeah.
Because there's no more PPP loan in the future.
Yeah.
Yeah. So that effect, for example,
It's a free money shot, really. That's what it was.
Yeah.
And then in the PPP loan for our international listeners, I believe it was based to payroll, right? Wasn't it based on payroll?
Yes.
Okay. Can you say a few things about this?
Yeah, so I think they had 2 or 3 rounds of subsidies. You know, the Germans know this Kurzarbeitergeld, and the Americans had a similar but different model where they based on your total payroll expenses, and once you commit yourself that you don't fire people, that's when you got a certain percentage of those of your payroll expenses to ensure that you keep your people employed. Because of course, Americans are more volatile and more flexible in the market because a lot of states are at will, meaning that the employees are employed at will and that you can fire them without any severance with a 2 weeks notice.
Yep.
And everybody expected this to happen in COVID times. And in order to avoid this, that's the reason why you got this governmental money and you booked it as a liability on your balance sheet.
Okay. Yeah.
So you got the cash, you booked it as a liability, and then 2 years later you wrote a letter and you said, hey, I complied with all of the requirements. I don't want to pay it back.
Yeah.
And that was, of course, the idea to begin with.
Sure.
But that happened 2 years later.
Yeah.
And then so you have to get your liability out of the books.
Yeah.
And that's the reason why you book a big profit
Right.
then later on.
Yeah.
And if you include that profit into your reported EBITDA figure, you have the first mistake.
Yeah, sure.
Yeah. So coming back to your point, could it be that something is completely off that was agreed in the letter of intent? Yes, but it's not the valuation, it's not the multiple. It's the basis, i.e. the profitability that has holes and that doesn't hold the water.
Yeah. And then, so what are some of the other items? I mean, there must be, when you see in P&L and income statement, there might be like, okay, they might be fudging things here. So I'll go straight to those points. What are some, I mean, you mentioned the PPP loan as one example. It must be something else too, where you're like, okay.
Well, for example, that the owner doesn't pay himself a salary. So you know that the owner goes away.
Yeah, and you have to hire someone.
You have to hire a new president / CEO. The guy costs $500,000. So those $500,000 need to be deducted from the EBITDA figure, from the reported EBITDA figure, in order to come up with a figure that is valid going forward.
Yeah.
Yeah. And it could be, that's the reason why we look into related party transactions a lot. So it could be rent. It could be anything that they did. That it could be even that he has a side business, and that a lot of the business that you see in the target business is only induced by his sister company that is not up for sale, and that may or may not stay.
Yeah.
So
it's really true forensics, like kind of looking through bank statements, looking at transactions, right, to really kind of figure out.
Yeah, I wouldn't call it forensic.
Okay.
I call it due diligence.
Due diligence.
Also, it's not an audit.
Okay.
Yeah. So an audit would be too detailed.
But you often have access to prior audits that you can actually use for your due diligence, right?
Yeah, that's a good point. So one of the cultural differences is that the U.S. figures are unaudited. Yeah, I would say 95% of all of my due diligences are based on unaudited figures.
Really?
Because you don't have an audit requirement, in contrast to Germany. In Germany, you have small, medium, and large companies. And then if they are GmbHs or if they are AGs, so if they are...
GmbH is somewhat similar than the LLC here in the US.
Yeah, or an Inc., exactly.
Inc,
so if you have corporations, and they exceed a certain size in number of employees or total assets or revenue, they need to be audited. And in America, you can have $1 billion revenue in your business and you don't have to be audited. You are only audited if somebody forces you to do so, or if you want to do it by yourself. Yeah. So, for example, if you have a lot of bank loans, the banks will force you, especially if it's risky. But in a lot of cases, you have bank loans and you don't have an audit. So that's the reason why it's absolutely normal to have unaudited figures. And the goal for me as a due diligence is not to audit those figures and come out with an audit opinion. Yeah, it's a due diligence. It's a bit, it's different. In a sense of, first of all, I don't try to look at all of the receipts and I don't do these kind of test work. Of course, if I see that something is fishy,
then you go into it. Yeah.
I will let the client know, and then we have to decide what is the consequence of not trusting the figures.
Right.
Yeah. In a lot of cases, it's you try to figure out to what extent they are in line with US GAAP, meaning are they really doing accrual-based reporting?
Right.
We still see cash accounting, so that you only recognize your revenue when you get paid.
What is it? Under 10 million, you can do cash accounting, right? And then
I think it's more now.
Okay, yeah.
I think it's 20 or 25.
Okay,
but that's just for tax purposes. So that's a tax rule.
Yeah.
But again, you don't have the requirement to maintain books for book purposes, meaning for GAAP purposes. Well, if you're a private company, you can do whatever you want. As long as you make sure that you can file a tax return that makes sense, you're fine.
Yeah.
But you don't have to be in line with US GAAP.
So for you then, the tax return is really extremely valuable, like looking back at 3 years of tax returns, for example, right? Because, I mean, that was reported to the IRS, so that there's a lot of liability involved in not doing that correctly.
You definitely reconcile the book financials with the tax financials, yes. And if they are significantly different, you want to understand what it is, which is part of the tax return.
Yeah.
To reconcile this.
Do you have clients, specifically German ones, that require an audit, like that make the seller go through an audit process?
Well, that's what I tried to say earlier. These cultural differences. So first of all, it's an eye opener when I tell them that the figures will be unaudited.
Yeah.
And I just have a client a week ago who called me and said, "Well, we have a policy to only do deals based on audited figures. And then I said, well, good luck to convince the seller that you want to perform an audit prior to the due diligence. Because, I mean, it costs a lot of money.
Yeah, sure.
And then you don't know whether you have a deal or not.
Yeah.
So ultimately, I could convince him that it's not a good idea to audit the figures prior to the due diligence, but that you do a due diligence and if you're still convinced that the deal is a good idea, then you do an audit on the closing balance sheet so that you have also that you have a good start with your own opening balance sheet then for your group reporting purposes post-transaction.
But so you would say to a potential buyer that you feel pretty good about your processes, your due diligence with your team, that it would be okay to go and close on a deal that was unaudited.
Correct.
Yeah. Okay.
Correct. Yeah. So it's never the goal for us to do an audit, and that's the reason why I'm saying it's a due diligence, also not forensic. I mean, yes, if you stumble over something and it looks fishy, you dive. Yeah, or let's say you dive after you consulted with a client.
Sure. Yeah.
Yeah, because sometimes it could be a deal breaker, and they say, well, I don't even want to dive into this, and you typically also have to agree to an additional budget for the extra work.
Yeah. Well, it's interesting too. You mentioned that often these are one-on-one deals, and the buyer and the seller may know each other already, right? So they probably have been to trade shows together. They know about their sales force, right? They know about their production capabilities and have studied their product or whatever it may be. So there's probably some familiarity already. So then you just go hunting for red flags, and if they're not there, then
and keep in mind, I mean, one of the other cultural differences are that you don't see anything publicly available.
Yeah.
So Bundesanzeiger, Handelsregister-Auszug, and published financials of a private company is something which is, I mean, since the reform of the HGB, so that you're really forced to publish your own financials. When I started in business, it was still like a very cavalier whether or not you do this, but then they pushed more into that you pay a fine if you don't publish. So now people do, but Americans are completely surprised that somebody would publish their own figures if you're private. So they don't do it. That's the reason why we sometimes have clients who say, well, can you figure out how much revenue they have? Yeah, and I say, yeah, I can call them and ask.
Yeah.
But there's no publicly available information in general.
To check it.
Yeah, and also when you do this kind of target search, when the client looks for it, you know, they look at websites. Meaning at the website of that company. And sometimes people invest a lot of money into their website, but the whole business is nothing.
Right.
Or vice versa.
Yeah.
Then sometimes you have these hidden champions who don't believe in online selling.
Right.
And then the website looks like crap, but in reality, it's a great business. So you only figure this out once you talk to them and once they opened up a little bit and give you some financials.
Very interesting. Yeah. This is a little bit similar to how we deal with clients that want to know about salary ranges, right? There's nothing public. I mean, you can go to Glassdoor.com or something like that, but to get really accurate data on what some kind of injection mold setter is going to cost hourly in X city or Y city is impossible to get unless you get anecdotal data, right? Same with what is an executive paid. There is no norm. It's really all anecdotal data, and there's no public way to really find this out unless you want to spend a fortune with some of these large houses where agencies where I still think the data isn't quite accurate to a specific geographic area. So very interesting. Yeah. Let me ask you this. So, I think we're hoping a little bit, and I think that's our audience as well, small to medium-sized businesses, what we call Mittelstand in Germany, lots of inbound business right now. Tell us a little bit, if someone is currently looking at acquiring a company in Germany, at what point should they contact you? What will be the steps that you go through with them? Like, walk them through an entire process that you would be going through with your team.
And you talk about a client in Germany buying a company in the US.
Correct. Let's say they want to acquire, they're looking at site selection, but it might just be easier to pick someone up, with already 80, 100 employees. May know someone in the industry, that they're familiar with, and they're looking at acquiring this company. Like, what will be the best way, starting to walk them through an entire
I
process.
think the biggest question is whether they will have an investment banker on the buyer side involved as well.
Okay.
Yeah. So, as I said, the vast majority of our deals, they know each other. But we do also have deals, and it increased significantly during COVID, both on the buyer side and on the sell side, that they engaged investment bankers.
Okay.
Yeah. So, and then those investment bankers, they work with a success fee. So they want to be involved and they want to lead the project. So in many cases, they found the target. Yeah. And that's also, I mean, that's their, I shouldn't say that's their largest, let's say, asset, but that was, of course, the biggest point why they think a success fee is fair. We are paid by the hour. Yeah? So we are not successful. And we also don't have, we want to be independent. We want to tell the client whether or not it's a good idea to do the deal.
Yep.
And that's the reason why we are strictly paid by the hour and not at all because of the deal happens or not.
Yeah. Yeah.
And then, so if the investment banker is involved in this, then they will run the process. And as I said, the big first cornerstone is to get to the LOI phase and sign the LOI. That's the biggest step. And then the next step is the confirmatory due diligence. That's where we have the 4 to 6 weeks. And then where you start to negotiate further stuff that you have not agreed to in the LOI. And even if the LOI is the best LOI in the world, you still have to agree to certain other things. Yeah, sometimes it's amazing. Then I had one client, and they said, "Well, we had a deal already. So we went in. We wanted to meet the seller, and then the seller didn't know that he would show up with lawyers and accountants."
Okay.
And it was
Awkward.
Yeah, it was awkward.
Yeah.
And by the way, the lawyers are not supposed to stay in the room if the other side does not have their lawyers in the room.
Yep.
So that was very awkward. But then ultimately, it was tough, but they still negotiated and they tried to get a deal. But then ultimately, the guy still got second thoughts. Yeah, our client haggled probably a bit too hard. The guy ran outside the seller and said, because it was his baby. Yeah. And he said, I'm still not sure whether I should really buy. I still have second thoughts whether I should sell this business.
Yeah.
And then the client said, well, we had a deal in February. I mean, this was like in May.
Yeah.
We had a deal in February. And then the lawyer and I said, no, you didn't.
Okay, yeah.
Because you didn't agree to all of these details. And now all of a sudden you try to play hardball. It was a minor point ultimately. I mean, the deal happened, by the way. And I think everybody was happy at the end of the day.
Yeah.
But it was interesting to see how emotional it could become.
Yeah, sure.
If in a negotiation it was a $20,000 item.
Yeah.
That they ultimately exploded on.
Yeah. Well, I guess so. Then they probably in negotiations they really got to what the seller was willing to sell it for at the very minimum, right? And what the buyer was really wanting to spend if they got in an argument over 20 grand. I mean, I'm assuming it's a large transaction. So interesting. How many? If you were to look at those deals, how often do you think it's a win-win scenario, or do you think generally that has to exist for a deal to go down, or do you see a lot of distressed sales or sales where there's a clear winner and a loser in the transaction?
No.
Yeah.
And I think I said this earlier. Nobody had to sell.
Right.
Yeah, because of COVID. I mean, financial crisis was a different story. But COVID was not. I didn't have any deal where the seller had to sell. Yeah, where the seller said. And where the seller also didn't have any negotiation left because his business was already down. Yeah. So the whole, let's say, buying out of bankruptcy is a very big anomaly for us. Typically, it's a running business. So that's the reason why I would say it's a win-win situation in general, in all cases. And sometimes even if you do a deal and you said, well, I could have negotiated harder. You have to look at the grand scheme of things.
Right, exactly. You're going to be ending up at the beach, so that'll be all right.
Yeah, and I always say also to the buyer,
yeah.
When they pay, let's make up an example.
Yeah.
If you pay 35 instead of 30, it doesn't become a bad deal because of that.
Right.
The last 10% of a purchase price don't make a good deal a bad deal.
Yeah.
Yeah. And quite honestly, we sometimes have the situation. Remember that I said earlier that the Americans are very good in negotiating.
Right.
That's also part of the point that the Germans say when the American is still negotiating the purchase price, and they say, okay.
Yeah.
Because he said, well, those 10%, if this seals the deal, I'm happy to pay that extra to just, end this negotiation.
To end the negotiation, yeah, interesting. We need to come to an end because we're already, this has been a great conversation, but I have one more question I asked you earlier, but I want to ask it for our listeners to hear it. So you always hear about multiples of EBITDA, right? Like who comes up with the multiples? Like are there industry specified multiples that you then take EBITDA and establish the purchase price, or is this the investment bankers that come up with them and then you check them? Like how is the purchase price established?
Yes. So what you have to understand is that there's one area that you call due diligence, and then you have a valuation area. And I'm doing this now for 24 years, and I still haven't figured out why there's a difference between those. Meaning, if you're good in due diligence, you're regularly not exactly an expert in valuations, and vice versa. These are two different departments at every firm.
Okay.
In the US, Rödl Partner doesn't do valuation services. If we need to have that, we work together with Rödl Partner Germany on that. And it's a very good and close relationship. So our client, if they don't know what they have to pay for it. But most of our clients, they know what they want to pay based on a certain multiple. So the short answer is, yes, there are data banks, not exactly, for smaller deals, not exactly accurate. Yeah. So if you look at comparables, if you look at other deals that are publicly available in the market, our deals will be rarely published with a purchase price. Yes, they may be published, but they never talk about the price. So that's the reason why the data banks cannot be that great anyway, because there's not much of a basis of publicly available information. And that's the reason why, to some extent, you have to believe in yourself. So my former boss always liked to say, the right multiple is the multiple that you're willing to pay.
Okay, yeah.
Having said that, most deals that we work on have a multiple between 5 and 8, maybe 9. But it depends on the industry, and it depends more on the potential. Yeah. So if you have a business that is super flat, super steady, it's probably a good business to know what you're getting. Yeah. But it may be then only a 6 of a multiple. And if you have a business where you have a lot of potential and they just showed it already, or they have a good track record that is longer than just a year, where you don't know whether that's a sustainable growth, it's a different multiple.
Yeah. Very interesting. Well, I think we have to wrap it up because we try to keep it around an hour, for our listeners to listen to this on their commute, for example. It's been very interesting, I think very, very informative for someone inbound or someone within the US trying to acquire another business. Frank, I really appreciate the time. At the end, I always like to ask if there's how can people find you? Is it LinkedIn? Do you have any other social media channels that you use?
Yes, I'm on LinkedIn. Thanks to my unique last name, you find me right away.
Okay, gotcha.
You just have to enter my name with a DT at the end.
Okay.
With Google, you will find me.
Okay.
And the Rödl Partner website is relatively good in that perspective as well.
Excellent, very good. Yeah, we'll make sure we like everything in the show notes and in the video so everybody can find Frank. Thanks again very much for this great time together. And to all of you listening, it would really help us a lot if you would comment on our videos. If you would like our videos, if you would share our videos, if they provide any value to you, we very much appreciate you listening, and we'd love to hear back from you. Thank you very much, everyone.